I'm going to turn it over to my colleague, Courtney, who is going to go through some house cleaning rules and regulations, and then we'll get started with the presentation. Courtney.
Thank you. Hi, everyone, and thank you for joining us today. Before we begin, I just wanted to go over a few things. If you could please make sure you're muted throughout the presentation, that would be a big help. I can go through and do it, but if you guys could just maybe also do that yourselves, that would be greatly appreciated. As far as questions go, if you guys have questions throughout the presentation, you can write them in the chat bar and we will go over them at the end of the presentation. We'll also give everyone a chance to speak out loud if they would like to ask questions that way. And I will also be sending the slides to everybody after the presentation, so look out for that email. And we'll also have this recording on our website for anyone that wants to watch it again. So with that, I'm going to hand it over to Chloe Parker to get us started.
Courtney, good afternoon. Thank you guys for coming. We wanted to take some time today to talk about the employee retention credit. This was greatly expanded in the stimulus passage passed in December and even updated this month. And it was often overlooked in favor of the PPP last March, but this is potentially worth a lot of money to businesses, especially businesses that are in a cash crunch. So we hope that this will help you get an idea of this credit and how it could impact your business. I wanted to take a moment to introduce our team here today. We have Pete Ryan, one of our partners and co-founders.
Hello, I'm Pete Ryan. I started Ryan Wetmore 1998 in Silver Spring. We've been in Montgomery County for about 33, 34 years. We now have 3 offices and 40 to 45 employees. And we represent a bunch of different industries. We understand our clients' businesses. That's sort of a differentiator. We also have consultants, MBAs on our staff that are not CPAs that allow us to, do these multidiscipline problems that we're, talking about today. It's been a crazy year, just with all the grant programs, who's eligible, how they all interact. So I'm happy to explain some of it today.
Great. I'm Chloe Parker. I've been with Ryan and Wetmore for about a decade now, and I specialize with working with growing businesses to create sustainable strategies, whether that's from a tax perspective, financial statements, or consulting on projects like this to get COVID relief funding. And then Jack Ramsey is also with us today.
Hi, I'm Jack Ramsey. I'm a consultant at Ryan and Wetmore. I've been working directly with employers, helping them take advantage of the many relief programs that have opened recently during the pandemic and building models to help our clients maximize relief.
So just to give you a brief overview of our presentation today, we'll focus on explaining what the employee retention credit is, how it's been expanded recently, how much this credit is worth, who is eligible for this, as well as the differences between 20 and 21. And then some other kind of the nitty gritty of claiming this credit. So without, I'll let Jack jump right in for us.
Yeah, so to get started, what is the ERC? Well, the ERC isn't, it's the employee retention credit. It's not a grant or a loan. It's unrelated to PPP, which is a big misconception we see a lot of people have. And in fact, you can participate in both ERC and PPP subject to some other stuff, which we'll get into later. So it's a fully refundable tax credit. That means that if the amount of the credit exceeds your tax liability, the amount of tax you would pay, the IRS will count that as refundable overpayment. It reimburses employers for qualified employee wages. And as the credit increases, it nets against your employer side Social Security tax. And your Social Security tax will decrease. So because of that, even employers with no taxable income, and so no income tax to pay, can actually receive ERC. And as I said, PPP borrowers are now eligible to claim the ERC subject to normal restrictions like everyone else. And we'll get into that later. And now, just last week, with the passage of the American Rescue Plan Act, the ERC has been extended all the way through 2021. And there's some other exciting changes that we'll get into. So we'll start out with a little bit of legislative history, just a quick overview. So on March 27th, 2020, the CARES Act originally created the Employee Retention Credit, or ERC, to encourage economically negatively impacted employers to keep their employees on payroll, essentially. At this point, you had to choose between taking PPP and ERC. However, in December 2020, the $900 billion stimulus bill significantly improved and extended ERC through the middle of 2021 with some big changes. And at this point, PPP borrowers became retroactively eligible, which is a huge opportunity because now many PPP borrowers can go back and claim the credit in 2020, as well as being eligible going forward in 2021. Now, just recently on March 11th, the American Rescue Plan Act was signed into law by President Joe Biden, and it again slightly improved ERC, expanded eligibility, and it also extended it all the way through the end of 2021.
So who is eligible? There are two ways for a business to become eligible. The first one is if you were fully or partially shut down by a government order due to the pandemic. And this can be any government order as long as it's actually a government order, so not just a suggestion. And it will be for things like reduced seating, a lot of restaurants would see, or if you weren't able to make deliveries or your delivery window shut, if you weren't allowed to have indoor dining, any sort of partial closure or reduction in hours that was required by the government. The other way you can qualify is if you had a significant decline in gross receipts from the current quarter or whatever quarter you're looking at in 2020 or 2021 compared to the same quarter of 2019. So either one of those would qualify you. The eligibility, this is one of the big changes, the amount that you're eligible for that Jack was referencing. So for 2020, it was good for up to $5,000 per employee for the whole year. And you used a $10,000 wage cap for that. So you got it for 50% of qualified wages. For 2021, it is eligible for $7,000 per employee per quarter. And that's going to be calculated at 70% of qualified wages, up to $10,000 of wages per quarter. So this is potentially worth a lot of money depending on your qualified wages and your number of employees. And this is going on for the entire year. Qualified wages at the very base are defined as the gross wages subject to Social Security taxes and the amount paid toward group health insurance benefits by the company. And we'll talk more about how you separate those wages from wages that you might use to calculate PPP forgiveness. But at the bare minimum, those are the wages. Moving forward, this has been extended to the third and fourth quarter as of last week. What industries can claim this? Just about every industry is available. This is available to them. So I don't know if we have anybody in retail on the call today by like a show of hands, but retail is eligible. Restaurants, breweries, bars, all eligible. Real estate, construction, manufacturing, not-for-profits are also included in this. So this is available for just about anybody who has seen that significant decline in receipts or that partial government shutdown.
So if we go compare, there's been a lot of changes as Jack and Chloe had mentioned, the difference between 2021, they passed the bill in the at the end of December 2020 and changed, made ERC eligible for 2021, and they changed a bunch of definitions. So one of the first definitions they changed is employers of any size, including tax exempt organizations, are now allowed. Before, government entities. Now employers of any size, we've had a lot of large tax exempt organizations that we've worked are now eligible. And also they've added things that employers are not in existence in 2019. There's ways to get them eligible as well. And so as Chloe and Jack have mentioned, in 2020, this really didn't affect very much of our clients. Most of our clients got PPP, or that they weren't, we have some clients that do $100, $200 million a year, and they have more than 500 employees. And so there was 2 requirements you had to meet in 2020. You had to have a 50% decrease in revenue, and you had to have a partial or complete shutdown. So again, there's not that many clients that actually had a 50% decrease. And in 2020, originally, if you had a PPP loan, you couldn't get the ERC credit. So when they passed the bill at the end of December, making you eligible to use both, that changed the whole game. So first in 2020, you have to have a 50% decrease, okay? And then when they changed the rules for 2021, this made, most of our clients were doing calculations today, figuring out what their gross receipts. You only need a 20% decline in gross receipts. Okay, if you're a control group or you own, a bunch of different organizations, you got to count them all together to do your 20% decline. And so what you would do is you compare the first quarter of 2021 to the first quarter of 2019, or the second quarter of 2021 to the second quarter of 2019. So again, this is a huge game changer. So, I want everybody to leave here with the thought that they're going to go back and they're going to compute their gross receipts, okay, for 2019 by quarter, and they're going to begin to track what their gross receipts are in 2021. The other thing that happened that was a big change is you can make an election in 2021 and say, instead of using for the wages I paid in the first quarter of 2021, I can compare the previous quarter for the revenue percent decline. So I can compare December 2020 to December 2019. And if I'm down 20%, I could just apply that and I can begin to get wages reduced, payroll taxes reduced right now. So again, this is the biggest change for 2020 to 2021. There's 2 huge changes. This is the first huge change. You only need a 20% decline in gross receipts in 2021 compared to gross receipts in 2019. And the other huge change, which is, a game changer, again, as far as how big the credit was. The original credit that was passed in 2020 is you limit it to 50% of up to $10,000 per wages per employee. So basically that was a $5,000 credit. And so if you had 40 employees, it would be 40 times $5,000. That would be $200,000. Okay, that was the maximum you could actually get. In 2021, the credit is now $70,000 for the first $10,000. So that's $7,000. So if you had 40 employees, that would be $280,000. But the biggest difference is you could, if your gross receipts are down by more than 20% every quarter, you can get that credit for 4 quarters instead of just a one-time thing. So that change was huge. The next large change was that originally in 2020, there was an FTE calculation. So the FTE calculation went, okay, if you had fewer than 100 employees, you just figured out if you're down 50%, you just got all the qualified wages times 50% up to $10,000 cap. And so again, if you're a large corporation with more than 100 employees, you only got a credit, again, if people actually did nothing. You paid people to stay home. Okay, or you paid them for 40 hours and they only worked 30 hours, and that 10-hour difference. Okay, so that was the huge difference. Again, there wasn't that many companies that were down 50% and paying people to do nothing. And the big change in 2021 is instead of 100 employees, you now have 500 full-time employees. And so again, if you're under 500 full-time employees, as long as you pay those people, whether they work or they don't work, it doesn't matter. You're still eligible for the credit if you meet the other criteria.
So to stay on that topic of eligibility, so there's new eligibility available with the passage of the American Rescue Plan Act, like we talked about earlier. So one new eligible category is recovery startup businesses. These are businesses that started after February 15th, 2020. So if you started a business after February 15th, 2020, starting in 2021, Q3 and Q4, you are eligible for the credit. However, you do face this additional restriction. Your total credit for each quarter is capped at $50,000 if you qualify this way. You can also qualify the regular ways by being shut down. And also, there is a new category of employer that is targeted for additional relief. So severely financially distressed employers, so people that were really hard hit and had a 90% gross receipts decline instead of just the other ones. The other percentage is 50 or 20. If you hit a 90% decline, you know, notwithstanding, so disregard the size requirements that Pete was talking about, all of your wages paid to employees during the quarter are potentially eligible, subject to the other normal rules about qualified wages, the $10,000 cap and whatnot. However, keep in mind that the changes in the American Rescue Plan Act extended the credit through 2021, but they're not retroactive. So they start taking effect on the credit after June 30th, 2021. So let's talk about PPP and ERC. A lot of people have PPP loans, and there's this misconception that if you have a PPP loan, it disqualifies you for ERC. It does not, and we have a bunch of clients that take both PPP and ERC and get a bunch of relief. So the answer is yes, you can have both. However, you have to be careful not to double count payroll costs between two programs, including PPP and ERC. So this also applies to FFCRA, Emergency Paid Sick Leave and Family Medical Leave Acts, leave credits that were just extended as well, and Provider Relief Fund reimbursements. So that's another reason why it's really important to have trusted advisors to keep track of those things for you. So here are some best practices for PPP and ERC. So if you've not yet applied for PPP loan forgiveness, many businesses will want to allocate the maximum amount of non-payroll costs for PPP loan forgiveness. So people who have reviewed the PPP loan forgiveness process will recall that you have to use 60% on payroll, and the other 40% you can spend on utility payments are one, rent payments as long as they're not to a related party, and some other categories. So you may want to max that out, and doing that will allow you to save those payroll costs to potentially use on ERC if you're eligible. So another thing to consider is consider the forgiveness period selection. With the passage of the CAA, Consolidated Appropriations Act, back in December, the new stimulus bill, they allowed people to choose their forgiveness period between 8 weeks and 24 weeks. That affects a lot of stuff for PPP. It affects your potential FTE, full-time equivalent reduction penalty. It affects your wage reduction penalty. You get penalized for all this stuff, and that could also affect how much payroll you have to use and how much is eligible to be left for ERC. So when we talk about optimizing stuff like this, this is one of the things that we're looking at. Another thing is you need to keep track of documentation to show that your company is not using the same wages. You're not double dipping between ERC and another program. So lastly, there was a recent IRS update that was separate from, these other legislative updates. And so essentially a big question that people had was, if you submitted more PPP forgiveness, then more PPP payroll costs than were needed for you to claim full forgiveness, were you eligible to claim some of those payroll costs with ERC? So a lot of employers had this. A lot of employers just submitted like all of their payroll costs for the covered period with PPP forgiveness to max out forgiveness. And that left them with a lot of excess costs that they weren't sure if they could use on ERC. Now, AICPA wrote a letter to the IRS asking them to clarify that those wages were eligible for ERC if they were not needed to claim the full forgiveness amount. And basically what happened is the IRS basically agreed with AICPA in this recent update. So you still can't double dip. However, if you submitted excess payroll costs, so remember you've got that 60% rule and you still need to substantiate the full forgiveness amount, but if you had excess, you are now potentially eligible to use those wages on ERC. So to give you an idea of how we navigate this when we look at these things, so there's a ton of relief programs that have come out in the last year. And including ERC, there's no double dipping allowed for most of these. So the question is, if you have to use some wages on one program and some wages on the other, how do you maximize forgiveness? How do you maximize your relief and ensure that you still get maximum PPP loan forgiveness with ERC? And how do you not violate double dipping rules? So you don't want to fall afoul of these things. So what we do is we create complicated models because these models may be necessary for clients to optimize their relief when they're involved in multiple programs that have trade-offs. So to give you an idea of some of the things, you need to select the PPP covered period. Like I said, you need to compute monthly average FTE if you're involved in PPP, qualified wages for ERC, reduction in average hours and wages. All of these things affect PPP or ERC. And if they affect PPP, they probably affect ERC as well. You need to model that to take account of it and make sure you're maximizing it. So what I specialize in and what we've been doing is we've been using models to compute and maximize relief in an integrated approach, which is really what's called for here. So you need to take into account PPP, ERC, and more. So I'll hand it over to Chloe.
So we're starting to get into the weeds here a little bit with it, and we're happy to take questions. I've seen a couple coming in, so please keep those coming. One of the big questions we have is regarding self-employed individuals, whether those would be someone with a Schedule C, or maybe if you are a member of a partnership, or if you are an owner of an S corporation. And what the rules have come out and said is that self-employed individuals themselves and their relatives are not eligible for the credit. So the government will not give you a credit for retaining yourself. However, they will give you a credit for retaining your employees. So people who are not related to you, not married to you, but actual employees are subject to the normal requirements, and this is available for them. So whether you're filing a Schedule C, an S Corp, a partnership, a corporation, this is available to be used. One thing we want to ping here and kind of bring to attention, I know this is always a pain point for most of the people I work with, is the documentation. You want to have this documentation ready to back up your credit. You want to have it saved. So there's just brand new guidelines out about this. And this is something, I guess this is a good point to put in, is stay up. If you want to be working with somebody, whether that's your accountant, your payroll company, us, where they're giving you regular updates, because even as Jack was referencing, this program has changed. We've had 3 different laws affecting this program, and we still have 9 months to go this year. So anything is possible, so stay up on that. But you want to keep this documentation in order. So any eligibility, as far as if there was a shutdown that you received notification of, your gross receipts calculation, you want to have that information readily available and saved. Qualified wages, you should have the payroll reports. You should be able to differentiate between these were my PPP wages, these are my ERC wages, these were my FFCRA wages. And this is something where, we're going to talk about getting more people involved, but getting the right people involved so you have the right things documented. For large employers, if you had people who were being paid but not performing services, you need to have documentation of that. You have documentation of your health plan expenses. If you're part of an aggregated group for tax filing purposes, you need to coordinate across your group and document how you're doing that so that everyone knows. And then we're going to talk about how to file, but you want to make sure that you have all of your applicable forms with you. How to claim. So there are actually several different ways to claim this, depending on which year you're claiming and when you're claiming it. So for 2020 is obviously over. So if you go back and realize, hey, I'm eligible for this during 2020, I have excess costs that weren't PPP, my wages were down, I was shut down, you can apply for this by doing in Form 941X. And we are typically seeing, I have gotten emails from Paychex and ADP about, hey, they're available to run those forms for you, but you need to coordinate to know what wages you're using for that. If you are looking at, hey, I'm going to qualify for this for 2021, there are a couple different ways to do that. The first is if you determine that, as kind of Pete and Jack were talking about those calculations, that reduction in gross receipts or shutdown, you can start claiming now and stop remitting payroll taxes. So this is cash in your bank account that gets to stay there. So if you are cash strapped, this is a really important credit for you. And the government's really doing its best to keep people in business, keep cash flowing in the economy. So you could stop remitting now, or you would be able to claim it when you filed your actual 941s at the end of the quarter. And finally, Jack was alluding to this earlier, but you can actually receive, if your applicable credit exceeds the employer portion of these payroll taxes, you can receive an advance on that credit. So the government will actually send you money now in anticipation of this credit and calculation, which could be a great funding source if you're trying to weather this pandemic.
So the question we have for everybody, what are your next steps? How do you get started? Okay. And, we can, there's all different ways to sort of look at it. So the first thing to do is talk to a trusted advisor. So you have to come away, okay, how am I going to go approach this problem? And, what's the right way to go forward? So you got to figure out who your team is, and communication is going to be key. And I'll give you some examples which have created a lot of problems for some of our clients already. So that's the first. And the second thing you have to do is determine what entity type you are. So Chloe alluded that if you're a partnership, wages, payments to partners are not wages. Okay. If you're a Schedule C, payments to yourself are not. But if you're a corporation or an S corporation, payments to yourself are wages because you get a W-2. The next thing you have to determine is what's your accounting method, cash or accrual. Most people under 25 million, but not all, in annual revenue are going to be on the cash basis. Okay, finding your tax return and figure out where we actually go in this is the next thing. The next thing is pretty simple thing. You have to determine your gross receipts by quarter for 2019, 20, and 21. So again, you leave here, that's the next thing you have to go do. And then compute your revenue change. So you're going to compute Q1 2019 to Q1 2021. You're going to compute Q2 2019 to Q2 2020 and 2021. And you're going to do the same thing for the third quarter and the fourth quarter. And so intrinsically, you sit there and say, well, we knew we were big. We had a lot of receipts in this quarter in 2019. So that's what that would be the plan for. We'll probably would qualify for this quarter in 2021. We'll probably be down 20% based on what I know. The next question is find out whether you were subject to a government shutdown, either full or partial. And there's a bunch of Q&A rules that, that give examples. If you fall into one of those examples, that's fine. We have clients that, were saying they were shut down because all their suppliers were shut down. We think that qualifies. So some of this stuff is pretty well straightforward. If you voluntarily shut down, we had a couple of construction clients who just voluntarily shut down for a couple of weeks, that wouldn't qualify. We've had other construction clients where they were actually shut down by a government order. They couldn't go to a building and do work. That would qualify. And then, and you could also decide, okay, across all, like if you're in 5 states and you were subject to a shutdown in one state and you decided to use that shutdown order for all your states and shut down, that would work. For restaurants, if you were like not able to seat at 100% capacity, or you're only able to do carry out, that would probably qualify. But you have to sort of, get the documentation and say, yeah, I've looked at it, I've talked to my advisors, and I feel pretty good about it. And so then the next thing is, once you think you've gotten through all that, is you have to obtain your payroll information for the eligible quarters in 2020 and 2021. Again, the reason you need to do this, because that's how you're going to compute the credit. It's a credit based on payroll. And so, as Jack has alluded, we've worked with a bunch of clients. We've actually gotten the payroll in an Excel file for all, if they were biweekly, we had somebody send us, for all the 2020 payroll and all the 2021 payroll. Some clients have sent us the 2019 payroll to determine the FTE calculation. So it all depends whether, this is simple or complex. Some people on the call today is rather simple. They qualify, they had these employees, there were less than 100 employees, okay? Determine interaction with PPP loans, no double dipping. As both Chloe and Jack had mentioned, okay, you cannot use the wages for PPP purposes and ERC purposes. So basically you're creating a spreadsheet with all your employees, and for every payroll period, you're sitting there saying, we're using this for PPP, we're using this for ERC, this is what's left, this isn't what was not left, okay? The other problem we've been actually having is that there's a coordination between all your advisors. And so that is something you sort of have to, maintain and figure out what advisor is doing what, and there has to be communication around all the advisors. So, there's plenty of scenarios where, like your payroll company doesn't know what your, person filling out this form is doing, or your payroll company tells you, to just use these payroll periods, and they have no idea that you've already applied for a PPP loan. If you guys had gotten any medical clients had gotten any provider relief funds, you can't use that. If you'd used a specific local grant for $10,000 to maintain payroll, you couldn't use that. If you claim any family medical leave credits, almost all our clients have, because they had somebody that had COVID, then they paid them for 80 hours. So you have to determine which payroll periods to use. We talked about it. You have to call a payroll company. A lot of times the payroll companies, some payroll companies have this up and running. Some other payroll companies do not have it up and running. It all depends on what's actually going on. And so we have a bunch of scenarios where, certain clients have turned around and, we had a client situation where, they had somebody that was doing an R&D tax credit, okay, and they slipped in this addendum to their R&D contract that said, hey, we'll do the ERC credit for 30%. They didn't realize that myself and the payroll department was already working on this credit for them. The credit was about $350,000. If they had signed that form, it would have cost about $110,000 for something that would, be less than, less than 100 hours worth of work, or the payroll company may have done it. And so once you all have all this, then you can file amended returns. You can sort of wait for the money. And, again, if, Chloe had went over the form 7200, if you file a 7200 form, it's taking, anywhere from 45 to 60 days to actually get it. Again, you would file a 7200 form if, you figure your credit is 300,000, your withholding, your federal withholding, your FICA tax, your employer FICA tax is only 100,000. So if you're supposed to get a $300,000 credit, you file this form, the government would actually send you the difference in a check. And again, if it covers all the payroll taxes, you just stop making payroll tax deposit, and then you're going to be accumulating more cash. And so again, I would say the coordination with everybody is important. Getting a plan, and we see a lot of people doing things that are not, not very smart, getting themselves in trouble. So technically, if you apply for, if you double dip, you put the same payroll on an ERC credit, and you put the same payroll on a PPP loan, that's fraud. And so that's, that scenario. Another thing to remember that Chloe mentioned is you have to save your documentation. If you're going to get audited, it's likely to happen in a couple of years, not next week kind of deal. And so those are some of the things we're talking about. It's a huge credit. We're working with our clients to get it. So this is the next form is form 7200, which I just talked about. Again, this is how you get an advance payment. So, it's really important for cash-strapped businesses. The credit is going to be so high, it's going to exceed the amount of tax. And sort of the wrap up here a little bit is not having a plan is the biggest issue. Not having documentation, which we talked about. Not considering a PPP loan when applying for the ERC, or the people you could actually have two different silos where somebody in the office is doing the PPP loan and somebody else is doing the ERC. Or you talk to your payroll company and they say, hey, we'll just go do it for you. And they don't realize you've applied for other loans. We've had medical companies have provider relief funds. And, there's other grants. We've had, restaurant groups that have gotten certain, Montgomery County grants and things like that. We talked about the excessive fees. And, you have to make sure you're going ahead and you're claiming all the credits for the right quarters. And then you also have to make sure that you're reconciling any advance payments when you're claiming the employer retention credit. That's going to happen with your payroll company in the 941. So again, you don't want to do these things in silos. You're going to have to communicate, with all your providers to try to figure out a game plan and execute it.
So moving on, just to go over this really quickly, to simplify the whole eligibility kind of complexities, we created a flow chart just for everyone to keep on hand for informative purposes. This is mostly stuff that we've already gone over. So feel free to look at this. We will send out the slides afterwards. So essentially, this is just a summary. Check if you've got a 50% gross receipts decline. Check if you are fully or partially shut down. And then, check your average full-time employees for 2019. And then, like we talked about, if you're a small employer, you are only, or you get to claim it on all wages, all of your Social Security wages, qualified health plan expenses, up to $10,000 per employee, no double dipping. Large employers face that additional restriction. For 2021, it's similar, however, it's only a 20% decline, so easier eligibility. You can use the previous quarter, and those size standards are bumped all the way up to 500. And now the credit is potentially $7,000 per employee per quarter, so a much more lucrative credit. And then now we have created a new flow chart because the eligibility requirements were changed again for Q3 and Q4 of 2021. So now essentially very similar to Q1 and Q2, but note that you've got, like we talked about, this additional way to qualify pandemic startup or recovery startup businesses. So if you started up after February 15th, 2020, you're potentially eligible. That's a way to qualify. You are subject to this additional gross receipts requirement. Your average annual gross receipts, if you qualify this way by being a recovery startup business, have to be less than $1 million.
So to conclude, we'll be able to take any questions about this, but once again, we're headquartered in Bethesda. We have 35 professionals on our team at Ryan Wetmore, and we're working very closely with clients to optimize this and do what we can to support them during COVID to make sure that they can focus on running their business and we can focus on that financial side from both a compliance and forward-looking financing perspective.
So, Chloe, do you want to take some questions? You want to start reading them off?
Yeah, so there's a few questions in the chat. First one, are financial advisory service firms able to claim ERC?
Yes.
Okay. Next, would a business be eligible for ERC if they were shut down but did not have a 50% revenue decrease?
So I can take this one. Yes, you are eligible. It's an either or type of thing, but something to keep in mind is if you qualify with the revenue decline, you're eligible for the entire applicable quarter. If you get shut down, you're eligible for the period of shutdown.
So again, it would only be for the period of shutdown. So if you're shut down for March 20th to April 20th, that's what would count.
Yeah.
Great. Is ERC amount taxable?
Actually, the answer to that question is a little confusing, but at the end of the day, yes. What happens is your wages are not deductible, and so in essence, it becomes taxable. But, stay tuned to make sure you have good advisors. If you follow the whole PPP legislative history, that question was bantered about. The IRS put out a few things that say it was 100% taxable. Finally, Congress got together and decided it was not taxable, and they passed the law. After the IRS tried to issue revenue procedures and so on. So right now it's going to be taxable, or the expenses are not deductible to get to the same place.
And those would be the expenses related to the taxes there, not necessarily the wage amount, but the credit amount.
Okay, and how about wages of family members employed at a business?
So those would not be deductible. The IRS is unfortunately not giving credits for retaining your family on payroll.
The IRS has been clear that that doesn't count. We think it's pretty clear if you own less than 50% yourself, those wages qualify. But again, these are Q&As that come out all the time. There is some question about if you own more than 50% where those wages not qualify. And so that is, again, that would affect S corporations and C corporations for wages paid.
Okay, and then yes, Jimmy, we'll be sending out I'll be sending out the presentation slides after this presentation. We'll have that information along with the recording that will be on our website if anyone would like to watch that. So it looks like those are the only answers or questions in the chat. If anyone has any other questions, you can unmute yourself and ask if you would like to. Doesn't look like we have any more, so we can go ahead and wrap up. Thank you to Pete, Jack, and Chloe for that presentation. It was super helpful. And thank you for everyone who joined us. And we hope everyone has a great afternoon.
Thank you.
Thank you.